On August 15, 1971, President Richard Nixon committed what he called temporary economic heresy. He severed the dollar's link to gold. That temporary measure is now in its 54th year, and it can never be reversed. Here's why. The moment Nixon closed the gold window, U.S. Treasury debt stopped being government borrowing and became the foundation of money itself. Picture this: Camp David, Maryland, the weekend of August 13th to 15th, 1971. Nixon summons his top economic advisors for an emergency meeting. The atmosphere is tense. Treasury Secretary John Connally, a former Texas governor known for his bluntness, presents numbers that should terrify any American president. Foreign central banks are draining Fort Knox, demanding $3 billion in gold for dollars in just the first 7 months of 1971 alone. At the current rate, our gold reserves, 281 million ounces, down from 650 million in 1957, will be completely gone within 3 years. Think about what that means. Countries around the world are essentially saying they don't trust our currency anymore, and they want the real stuff backing it. By Sunday evening, Nixon makes a decision that will restructure global finance forever. But here's what most people don't realize. This wasn't a sudden crisis that came out of nowhere. The cracks had been showing for years, and the pressure had been building to an inevitable breaking point. Let's rewind to March 1968, 3 years before Nixon's announcement. The London Gold Pool, established in 1961 by 8 central banks to maintain gold at $35 per ounce, is hemorrhaging 1,000 tons of gold in just 3 months. Speculators around the world sense weakness in the system, and they're attacking. On March 17, 1968, the pool disbands in what amounts to a quiet surrender. Our Federal Reserve has provided nearly 50% of those gold losses, approximately $3 billion worth of our national treasure, flowing out to speculators who correctly bet against us. A 2-tier system emerges from the wreckage. Official transactions still happen at $35 per ounce, but private market prices float above $40. It's a system built on a polite fiction that everyone knows can't last. Then comes May 1971, and the dominoes really start falling. West Germany's Bundesbank, overwhelmed by dollar inflows that threaten to inflate their economy, stops defending the fixed exchange rate on May 5th. Within days, they absorb $1 billion in unwanted dollars, money they didn't ask for, don't want, and can't get rid of. Switzerland follows on May 10th. Country after country is essentially saying, we don't want your dollars anymore unless you can prove they're worth something real. The Bretton Woods system, the framework that governed global finance since World War II, is collapsing in real time. Countries are refusing to exchange their goods for dollars they suspect are overvalued, and they're right to be suspicious. Have you ever wondered why Nixon chose a Sunday night to make his announcement? Because markets were closed. There would be no immediate panic, no rush to dump dollars, no emergency trading. By Monday morning, the deed would be done, and the world would have to accept the new reality. Now here's where it gets interesting. When Nixon closes the gold window, the Federal Reserve holds $11 billion in gold certificates backing $80 billion in currency and bank reserves. That's already a stretch, about $7 in circulation for every dollar's worth of gold backing it. But over the next 3 years, something remarkable happens. By December 1974, the Fed's balance sheet shows a completely transformed reality. $95 billion in U.S. Treasury securities have replaced gold as the primary asset backing our money. Let me put that in perspective. Before 1971, when you held a dollar bill, it was technically an IOU for gold, a promise that you could, in theory, exchange it for something tangible. The Treasury debt itself was backed by the promise of gold redemption. It was a chain of promises that ultimately led to something real. After 1971, the entire system inverts. Now our dollars themselves are backed by Treasury debt. Every dollar in existence has a corresponding Treasury security somewhere in the financial system. Federal Reserve notes are literally notes backed by federal debt. Read the fine print on a dollar bill sometime. It doesn't promise gold or silver. It's a promise backed by another promise, backed by our government's ability to tax our economy. The national debt didn't just grow larger after 1971. It became structurally necessary to the functioning of money itself. Think about this scenario. You're a foreign central bank in 1972, trying to figure out what to do. With the dollars you hold from selling goods to American consumers, before, you could theoretically exchange them for gold at Fort Knox. Now what? The only safe option is U.S. Treasury securities, our government's debt. But here's the twist. You need those securities not just as an investment, but as the backing for your own currency. When Japan issues yen or Germany issues marks, they need reserves to back that currency. And increasingly, those reserves are our Treasury debt. The transformation is complete by the mid-1970s. Our debt stops being something we owe and becomes something the world needs. It's no longer a burden to be minimized. It's the collateral that backs the global reserve currency. What if I told you that every major financial system built since 1971 depends on this arrangement continuing, that paying off our national debt would be like pulling the foundation out from under a skyscraper while people are still inside? According to the Federal Reserve's own historical data, the shift was deliberate and systematic. The Fed needed something to replace gold on its balance sheet, and Treasury securities were the only asset large enough and liquid enough to do the job. But this created a feedback loop. The more the Fed needed Treasury debt as backing, the more the Treasury needed to issue, the more the Fed needed to buy, creating an ever-expanding cycle. Here's what should grab our attention. Nixon called it temporary because he thought we'd eventually return to some form of gold backing, or at least a more restrained monetary system. 54 years later, we're not even discussing how to reverse it anymore. We're discussing how to make sure the debt keeps growing fast enough to support the expanding financial system built on top of it. The moment Nixon closed the gold window, he didn't just change monetary policy, he inverted the entire relationship between money and debt. Our national debt transformed from a necessary evil into a necessary foundation. And once that transformation was complete, there was no going back without dismantling everything built, since this wasn't a mistake or an oversight. This was the solution to a problem the world collectively decided it had. The question is, does anyone remember what problem we were actually trying to solve? So, we've seen how Nixon's decision transformed our debt from borrowing into the foundation of money itself. But here's where the story gets even more interesting. In the decades that followed, an entire architecture of global finance was deliberately built to require Treasury debt at every level. It's not just backing our currency anymore, it's the collateral for virtually everything in modern finance. Let me show you how deep this goes. The system works in layers, each one requiring Treasury debt to function. Think of it like a building, where every floor depends on the foundation, but also where each floor serves as the foundation for the floor above it. Remove one layer, and everything above it collapses. Layer 1 is bank reserves. The Federal Reserve Act of 1913 established that member banks must hold reserves. And by the 1930s, these reserves were primarily held as deposits at Federal Reserve banks. But here's the key. Those deposits are backed by the Fed's holdings of Treasury securities. Today we have $3.4 trillion in bank reserves at the Fed, existing as electronic liabilities backed by the Fed's $4.8 trillion Treasury portfolio. Your bank's ability to function depends on reserves that depend on our government's debt. Layer 2 is the repo market. And this is where things get really fascinating. The repurchase agreement market is essentially the circulatory system of finance. Each night, approximately $4 to $5 trillion in Treasury securities are posted as collateral for overnight loans between banks, hedge funds, money market funds, and dealers. Without treasuries, this market, which determines short-term interest rates and enables daily liquidity for the entire financial system, simply cannot function. It would be like trying to run an economy without blood flowing through its veins. Layer 3 is international reserves. Foreign central banks hold $7.9 trillion in global reserves according to IMF data, with approximately $4.8 trillion in U.S. Treasury securities. But here's what most Americans don't realize. These aren't investments in the traditional sense. These are the monetary base for their domestic currencies and the collateral for their international trade. When China issues yuan or Japan issues yen, they're not just creating money out of thin air. They're backing it with our Treasury debt layer. 4 is derivatives collateral. The Bank for International Settlements reports $632 trillion in outstanding derivatives contracts. Yes, you heard that right. $632 trillion in notional value. U.S. Treasuries serve as the preferred collateral for clearing and settling these contracts through systems like the Fixed Income Clearing Corporation. Without sufficient Treasury debt, this massive derivatives market, which includes everything from interest rate swaps to currency hedges that companies use to do business globally, would seize up overnight. Now let me show you how this system was deliberately constructed through specific decisions and crises. September 1981. The Federal Reserve Bank of New York officially designates 36 primary dealers, institutions obligated to bid at Treasury auctions and make markets in government debt. These aren't just any banks, they're the elite institutions required to ensure that when our government needs to borrow money, someone will be there to lend it. By 1985, these dealers are financing $50 billion daily in Treasury positions through repo markets. Today's 24 primary dealers, including J.P. Morgan Chase, Goldman Sachs, Citigroup, and Nomura Securities, handle approximately $640 billion in daily Treasury trading volume. They're required to absorb new issuance regardless of demand. Think about that. Our government has created a system where the largest financial institutions must continuously buy our debt as part of their franchise to operate. Then comes March 1988. And this is a critical moment that most people have never heard of. The Basel Committee on Banking Supervision publishes the Basel I Accord, establishing international bank capital requirements. U.S. Treasury securities receive a 0% risk weighting. What does that mean in practical terms? Banks need zero capital cushion to hold them, unlike the 8% requirement for corporate bonds or 4% for municipal bonds. This regulatory blessing makes treasuries uniquely valuable as bank assets. They count as the safest possible holdings, while requiring no capital to be set aside against them. Basel II in 2004 and Basel III in 2010 maintain this special status, with Basel III explicitly allowing unlimited treasury holdings for liquidity requirements. The global regulatory framework has essentially enshrined our government debt as the definition of risk-free. Every bank in the developed world operates under rules that say U.S. Treasury debt is safer than anything else on Earth. But regulations and designations are abstract. Let me show you what happens when this system faces real stress. September 15, 2008. Lehman Brothers files for bankruptcy. The firm had been financing approximately $200 billion in positions daily, much of it backed by Treasury collateral. Within 72 hours, the repo market freezes. Haircuts, the discount applied to collateral, spike from 2% to over 20% for non-Treasury securities, while Treasury haircuts remain at zero. Think about what that tells you. In the middle of the worst financial panic since the Great Depression, when no one trusts anyone, Treasury debt actually becomes more valuable, not less. The Federal Reserve launches the primary dealer credit facility on March 16, 2008, ultimately lending $9 trillion total across all facilities using Treasury collateral to prevent complete systemic collapse. Not 9 billion, 9 trillion. That's more than half our current GDP, created as emergency lending, because the collateral system based on treasuries briefly malfunctioned. According to the Federal Reserve's own crisis reports, the fundamental problem wasn't that banks made bad loans, though they did. The fundamental problem was that the collateral chains built on treasury debt seized up, and when those chains broke, nothing else could serve as a substitute. Fast forward to December 2010. The Dodd-Frank Wall Street Reform Act mandates central clearing for standardized derivatives. This is Congress trying to prevent another crisis by forcing transparency. The Commodity Futures Trading Commission rules specify that clearinghouses must accept high-quality liquid assets as collateral, primarily U.S. Treasuries. The Fixed Income Clearing Corporation alone now clears $290 billion in Treasury trades daily. Without sufficient Treasury debt, these clearing mandates that Congress passed to protect us literally cannot be met. We created regulations to make the system safer that actually made it more dependent on our government debt. Then comes March 2020, and this one should really make us pay attention. Between March 9th and 23rd, 2020, even U.S. Treasury markets become illiquid as investors dump bonds for cash in a panic. If Treasuries are supposed to be the ultimate safe asset, the thing everyone runs to in a crisis. What does it mean when people are running from them? The Federal Reserve intervenes with $1.6 trillion in Treasury purchases over 3 months, the fastest expansion in history. The Fed's holdings grow from $2.5 trillion in January 2020 to $5.3 trillion by April 2022 in Treasuries alone. The crisis reveals something profound. Even slight disruptions in Treasury market functioning threaten the entire system. It's not enough for our government to issue debt. That debt must be abundant, liquid, and continuously available, or the whole structure wobbles. Have you noticed the pattern? Every financial crisis since 1971 has resulted in expanded Treasury debt and increased Fed holdings. The 1970s oil shocks, 1987 Black Monday, 1998 long-term capital management collapse, 2008 financial crisis, 2020 COVID-19 pandemic. Each one prompted Treasury issuance and Federal Reserve intervention. The debt doesn't grow despite crises. It grows because the system requires it to function. And crises reveal just how dependent we've become. Here's what keeps me up at night. We've built a global financial system where stability requires continuous expansion of U.S. government debt. Not because politicians are irresponsible or because we lack fiscal discipline, though those might be true too, but because the collateral base of modern finance literally cannot function without it. Think about your own financial life for a moment. Your bank holds Treasury securities as reserves. Your money market fund is required by law to hold treasuries for liquidity. Your pension fund uses Treasury-backed repo markets to manage cash. Your company uses derivatives cleared with Treasury collateral to hedge currency risk. Every level of modern finance that touches your life depends on the continuous availability of our government's debt as collateral. The system didn't evolve this way by accident. It was constructed through deliberate policy decisions, regulatory frameworks, and crisis responses over 5 decades. Each decision made sense in isolation. Of course, banks should hold the safest assets. Of course, we need collateral for lending. Of course, we should clear derivatives centrally. But the cumulative effect is a system that treats U.S. Treasury debt not as one asset class among many, but as the irreplaceable foundation of everything else. And once you build a system this dependent on continuous debt issuance, you can't simply decide to stop. The debt isn't growing out of control. It's growing exactly as much as the system requires it to grow. The question isn't whether we should pay it off. The question is whether the global financial architecture built over 50 years can function if we tried. So, we've seen how the system was built. Now let's talk about why it can never be dismantled. Our national debt stands at $36 trillion today, and that number supports over $100 trillion in financial assets globally. But here's the paradox that should fundamentally change how we think about government debt. In the modern system, reducing the debt actually causes financial crisis rather than preventing it. Let me show you what I mean through recent examples that prove this isn't theoretical. It's happening right now. March 10th, 2023. Silicon Valley Bank fails with $91 billion in assets. Now, pop quiz, what caused this failure? Bad loans to risky tech startups? Fraud? Management incompetence? None of the above. Silicon Valley Bank held $80 billion in Treasury securities and mortgage-backed securities purchased in 2020 and 2021 at low interest rates, when the Federal Reserve raised rates from 0.25% to 5% between March 2022 and March 2023. These Treasury holdings, remember, the supposedly risk-free assets that banks are encouraged to hold, lost $15 billion in market value. The bank didn't fail from making bad loans. It failed because its Treasury collateral wasn't liquid enough when depositors wanted their money back. Within days, First Republic Bank with $213 billion in assets and Signature Bank with $110 billion face bank runs. The crisis demonstrates something critical. Even treasuries must remain abundant and liquid, or banks fail. Not just any banks, banks that followed all the rules, held the safest assets, and did everything regulators told them to do. Think about what that means for our debt. If we reduce Treasury issuance to pay down the debt, we'd reduce the supply of the exact collateral that banks need to remain stable. We'd be creating the conditions for more bank failures, not fewer. September 2023. The Federal Reserve's overnight reverse repo facility sees balances plummet from $2.6 trillion in December 2022 to $1.2 trillion by September. Financial journalists report this as money leaving the Fed. But here's what's really happening. It's a Treasury shortage. Institutions need to hold actual Treasury securities rather than lend them to the Fed overnight because there aren't enough Treasuries available in the market. The Treasury Department responds by announcing $1 trillion in new borrowing for the fourth quarter of 2023, explicitly to provide collateral to markets. Read that again. Our government borrowed $1 trillion, not because it needed the money for spending, but because financial markets needed the collateral. The debt increased to stabilize the system, not to fund programs. Now, let's look at October 2024. U.S. national debt reaches $35.7 trillion. You'd expect crisis, panic, spiking interest rates as the world loses confidence in America's ability to repay, right? Instead, this milestone is met with record low Treasury yields on 10-year notes at 3.8% and overwhelming demand at auctions. The October 9, 2024, auction of $42 billion in 10-year notes sees a bid-to-cover ratio of 2.67, meaning there were $112 billion in bids for $42 billion in bonds available. Investors were fighting to lend us money at rates that barely cover inflation. Foreign holdings total $8.1 trillion, according to Treasury International Capital data, with Japan holding $1.13 trillion, China holding $775 billion, and the United Kingdom holding $750 billion. The market isn't worried about too much debt. The market is positioned for more debt, demanding more debt, and would actually panic if debt issuance slowed significantly. According to the investment company Institute, U.S. money market funds manage $6.7 trillion in assets as of November 2024, up from $3.8 trillion in January 2020. These funds are required by SEC Rule 2-7 to hold at least 10% in daily liquid assets and 30% in weekly liquid assets, primarily Treasury securities and repo, backed by Treasuries. The fund industry alone requires continuous Treasury supply just to function legally. If we paid down the debt, we'd force money market funds, where millions of Americans park their savings, into regulatory violation. Let me paint you a scenario. Imagine Congress passed a law tomorrow requiring a balanced budget and steady debt reduction. What would actually happen? First, the Federal Reserve would need to shrink its balance sheet as Treasury securities matured without replacement. That $4.8 trillion in Treasuries backing bank reserves would decline. Bank reserves would contract, forcing banks to reduce lending. Money supply would shrink. That's not a policy choice, it's mathematical necessity. Every dollar of debt paid off requires destroying a dollar of bank reserves and money supply. Second, the repo market would face a collateral shortage. That nightly $4 to $5 trillion in lending would need to find alternative collateral, but nothing else has the combination of safety, liquidity, and regulatory acceptance that Treasuries have. Overnight lending rates would spike. Banks unable to secure funding would fail or merge. We'd see a credit crunch not from bad economic policy, but from good fiscal policy implemented in a system structurally dependent on debt. Third, foreign central banks holding $4.8 trillion in treasuries as reserves would face a crisis. As U.S. debt declined, they'd need to find alternative reserve assets, but there aren't $4.8 trillion worth of equally safe, liquid alternatives available. The Eurobond market is fragmented across countries. Chinese bonds aren't convertible. Japanese bonds yield near zero. These central banks would be forced to either hold declining reserve levels, threatening their own monetary stability, or shift to riskier assets, increasing global financial instability. Fourth, the $632 trillion derivatives market would face a collateral crisis. Clearinghouses require high-quality collateral, and the regulatory rules explicitly specify Treasury's alternative collateral, like corporate bonds or mortgage securities, require capital charges and face liquidity concerns. Derivatives markets would contract, increasing hedging costs for every company engaged in international trade or managing interest rate risk. Your mortgage rate, your company's borrowing costs, the price of imported goods, all would rise not because of inflation, but because of the collateral shortage. Now let's talk about who actually benefits from this system and who pays the price. The winners are clear. Primary dealers like JP Morgan Chase, Goldman Sachs, Bank of America Securities, and Citigroup earn bid-ask spreads on $640 billion in daily Treasury trading. JP Morgan alone reported $2.1 billion in fixed income trading revenue for the third quarter of 2024, heavily weighted toward government securities. The Federal Reserve holds $4.8 trillion in treasuries, earning interest that provides the mechanism for monetary policy. Money center banks hold $1.2 trillion in Treasury securities as zero-risk weight assets that simultaneously satisfy regulatory requirements and generate returns. Foreign central banks use Treasury holdings to back their currencies and maintain international reserve status. But who loses? Future taxpayers, us, our children, our grandchildren, currently pay $879 billion annually in interest on the debt for fiscal year 2024, up from $352 billion in 2021. At current growth rates, the Congressional Budget Office projects interest costs will exceed $1.6 trillion by 2034, consuming 3.6% of GDP purely for interest payments. That's money that can't be spent on infrastructure, education, defense, or anything else. Dollar savers lose as debt expansion drives monetary base growth and purchasing power erodes. The dollar has lost 98% of its 1913 purchasing power, with acceleration after 1971. According to the Bureau of Labor Statistics inflation calculator, $1 in 1971 requires $7.47 today to buy the same goods: your savings, your salary, your fixed pension, all declining in real value to support a system that benefits financial institutions. Anyone outside the financial system loses Main Street businesses and individuals who don't participate in repo markets, derivatives trading, or Treasury speculation bear the tax costs without accessing the system's benefits. The median household sees debt as a burden to be paid off. For Wall Street, it's essential infrastructure that generates profits. Here's the uncomfortable truth we need to face. The system isn't broken. It's working exactly as designed. The problem is that it was designed to solve the problems of 1971, and now we're locked into the solution with no exit. We've built a global financial architecture where stability requires the continuous expansion of U.S. government debt, not as a policy preference, but as a structural necessity. What if I told you that every politician who campaigns on paying off the national debt is either ignorant of how the system actually works or lying to get elected? The debt can't be paid off without dismantling the collateral base of global finance. It's not a question of political will or fiscal discipline. It's a question of whether we're willing to collapse the banking system, freeze the repo market, destabilize foreign currencies, and seize up the derivatives market all at once. Remember August 15, 1971, when Nixon's temporary suspension of gold convertibility changed everything? It wasn't a bug, it was the feature. The system that emerged doesn't just tolerate perpetual debt, it requires it. Every dollar in circulation, every bank reserve, every repo transaction, every derivative contract, every foreign central bank's monetary base depends on U.S. Treasury debt as collateral. Paying it off wouldn't free America from obligation. It would destroy the collateral backing the global financial system. The debt isn't the problem anymore. It's the solution the world has built everything on top of. And there's no going back without tearing down everything built since 1971. So, the next time you hear someone say we need to pay off the national debt like a household paying off a mortgage, you'll know the truth. Our debt stopped being like household debt 54 years ago. It became the foundation of money, the collateral for banking, the backing for foreign currencies, and the essential ingredient in global finance. We don't have a debt problem. We have a system that can't function without debt. And that's a very different challenge to solve. The question isn't how to pay it off. The question is whether we're even asking the right question anymore.